Hey, Derek Keet, Remax Elite. I've got Phil with us again.
Hello, hello.
And today the question is just, basically it's more of a general question, and we just wanted to have a bit of a chat on just investment strategies or strategies that work for investors. Before we get started, please like, subscribe, give us that thumbs up. Thank you. And maybe what's on? Yeah,
For sure. My name is Phil, everyone, from PJ Mortgage, and I deal with quite a few investors. So this is a common question I get a lot. We'll just run down a few examples. One that most people can use actually when they do have a mortgage that they are breaking and have a penalty to do with that, and not a lot of people use, or not enough, I would say, is that if you have an available line of credit or a home equity line of credit, most mortgages have a prepayment option, which is going to be 15 or 20%. So you can actually pay down 20% of your mortgage and pay less of a penalty, and then when you sell the home, then you just repay that line of credit that you have, and that will beat down your penalty by $3,000 or $4,000 easy. And you only do this if you're going to sell your house or refinance and are breaking that mortgage, because then you get to replenish that line of credit that you're using to put back into your home. Hopefully you can follow me here, but it really shortens that penalty. So that's one that most people can use. Second is for any investor that is trying to get into the market or just starting off. Let's say you're buying a home, you're buying your first home. You can put 5% down, because sometimes 20% is a lot of money for sure. If you're talking about a $500,000 home, that's $100,000. Now you got to read how long you have to live in the home for, because you do sign an affidavit when you put less than 20% down. But after that, you can rent out that home, go buy another one, and it's a lot easier than what people think, because we actually can use the rental income from your original house. As long as you have that down payment that's not in your home, you can keep adding to your real estate portfolio that way. I've had some people start this at age of 21, and by the time they're 30, here in Edmonton, they have 4 or 5 homes already. So they just have people paying off their mortgage, and it works well for them.
I think a lot of people are not afraid, but they think, like, okay, I can take this down payment and I can buy my home or my primary residence, but they feel that the bank is not going to give them money for these other properties, right?
Yeah.
So another idea is working together with other people, right? Mm-hmm. So a lot of the time, I was surprised too when you have these investors that own multiple properties, but a lot of it is owning them together with other people. Right?
Co-buying for sure is definitely a bigger thing, especially as real estate prices have gone up over the past couple of years all across Canada. I talk to people in BC and they see co-buying a lot, and this can really help your situation in most cases. Sometimes you have a bad co-buyer and it doesn't, but in most situations, because you are combining your possible income, you're combining down payment, you just have to make sure that you're good to go and getting in business with who you know, and it can definitely make that more affordable. The last one is more of if you're trying to put more money into your house. A good product is something called a home equity line of credit. It's going to be one of the cheapest pieces of credit that you can get in terms of like just a up and down line of credit, something that's free flowing there. So
no, I just applied for one, right?
Yes.
With Phil here, yes.
And they work very well, because you can freely take it out and do work into your home. You can, if you are an investor, you can write off the interest for tax purposes. So,
and one thing I was mentioning as well is with the home equity line of credit. We did another video about that. Definitely, you can see that in there. But with that as well, it's like when everything is good, so when the market is high and the price is high, it seems like the bank is willing to give out a lot of money, right?
Yeah.
But when the market crashes, the bank usually tightens up. So the idea of getting a HELOC when everything is maybe just normal, or everything's kind of high for when you need it later. It's easy to grab that money out. And I think what you were saying as well is investors take advantage of that, right?
For sure, 100%, because they have access to money at a lower interest rate than it would be with a normal line of credit or a normal loan in most cases. So it can just be a good way to have free access for emergencies or investment opportunities. I see people use this as their down payment for sometimes in a property that has a lot of equity, and it can just be a very useful tool.
You were saying that a lot of even if they have multiple properties, then they'll have one on each property.
Yes.
So then they can just pull money if they need to.
For sure.
Yeah.
For sure, because you've got to do renovations sometimes. With houses, they are tangible assets, so you have to take care of them and maintain them, and you can just have, instead of selling off investments and having to pay taxes on that, you can take it from the home equity line of credit and actually write off some of the interest, so it can actually be a tax write-off as well.
Plus it's sitting there. So the idea is buying the house, having a certain amount off, getting a home equity line of credit, and then pulling that money out to buy more property or to do these sort of things as well, right?
For sure.
Depending. But then sometimes, like when it comes to your down payment though, the bank won't accept, if you're pulling it from a line of credit to make the down payment.
It does make it a little harder. So for your average Joe, if the if the down payment is coming from a line of credit, this will really impact your borrowing power.
Right.
And so a lot of the times with investors, we actually temporarily get into alternative lending, just to make it easier, because there is some pretty cool programs on that side. I know a lot of people are kind of scared of the alternative lending route, but the rates and fees are actually relatively similar, and it beats out paying taxes. So they kind of look at situations with a little bit more common sense. Or
getting the vendor. So what I've done in the past is get the vendor to sell. So the seller, get them to hold the mortgage, right?
Yeah.
So in that case, like I've got quite actually even a lower interest rate. I've been able to do that in the past. But then that's also market dependent, right? Like obviously if you're in a market where there's multiple buyers and everything's there, it's usually the seller's not gonna want to offer it. Like why, right? But as soon as, like if you've got sellers, you're in a market where, or it's even searching for those sort of things as well. So if you've got the home equity line of credit available, then you can also use it with those sort of lending as well, right?
For sure, 100%. And you want to use this debt as smart debt. Obviously, you don't want to go spend this on a car or anything like that.
Right.
You want to use it for investment or emergency purposes.
For sure. Awesome. And if you have any other questions, please ask them below. Awesome. Thank you.